Okay, welcome everybody to Renewable Energy Deal and Asset Management Financial Modeling. I'm delighted to be presenting this with Manesh Hebar from CohnReznick Capital. It's Hayden Palliser speaking. Just as a quick introduction, first of all, this is the first of a two-part webinar series. The second one is around tax equity risk. Which party of a transaction is taking what risk for what return they're receiving? So between the sponsor, tax equity, and also the lenders themselves. And really, how does that change under certain cases, under downside cases, for example, who takes what risk where? So that's the next webinar. We will confirm a date shortly on that one. We will also be preparing a white paper, just a paper that outlines what are the main sensitivities exactly that typically run within a deal and how do those affect the returns themselves. And that will be in the following weeks. If you have any questions whatsoever throughout this webinar, you can go to the question answer part of Zoom and you can post your questions. We may answer some of those in writing, and others we will stop and take pauses and just answer those questions as we get to them. Given the COVID-19, we are doing this all remotely. I know some people were using Zoom and some people have had problems, although Zoom's been a great platform, some people have had issues. And if you cut out, you should better log back in again. It's outside of our control with a huge uptick in people dialing in remotely to various things around the world. But we'll make this as smooth as possible, and a full recording will be available at the end of the session as well. Okay, so with that, in terms of the this webinar particularly, what we're covering is, first and foremost, what's the real purpose and the content of a renewable energy deal model itself, and what are the sensitivities that we typically require, and what are the key outputs that we look at from a deal standpoint and a model. We'll then turn our attention into how to configure a model for asset management purposes. So what do you change or what do you do differently in an asset management or an operating project's financial model compared to that of a deal model? So with that, a quick introduction to myself. My name is Hayden Palliser. I'm one of the co-founders at Pivotal 180. I'll give an introduction to Pivotal shortly, but primarily we provide training within the project finance, renewable energy world across financial modeling and managing transactions. I'm delighted to be doing this webinar together today with Manesh Hebar of CohnReznick Capital. He's a man full of wealth and knowledge in the sector. A lot of you people probably know who he is. But quickly, he's a managing director with CohnReznick Capital. He's got extensive transaction experience in sort of buy-side advisory and a full stack of capital raising, equity, tax equity, and debt. His core focus has been on utility scale wind and solar projects, but he's also advised on transactions in residential and commercial scale solar space. He served as a financial advisor or invests on over 30 equity, debt, and lease closings of more than 7 gigawatts capacity and over $8 billion of capital in the clean energy sector. He also leads CohnReznick's internal modeling and structuring team that focuses on the complex modeling required for these deals, providing innovative structuring solutions and establishing broader product expertise and training with clients. So he's a man who knows his job well, and I'm really excited to be presenting this together with him. So I'll hand across to Manesh.
Well, Hayden, thank you very much for the introduction. It's an honor to be co-hosting this webinar with you. Thoroughly impressed with the work that you and Dan Gross are doing at Pivotal 180, and as a firm, we've certainly benefited from the people that you've trained and prepared, and many of which are now working for us or our clients. I know there are a lot of folks on the phones and home computers listening to us today, and we really do appreciate the time you're spending to learn more about something that we're very passionate about. Provide a bit of background on CohnReznick Capital. We provide investment banking services to the sustainability sector. Since 2008, we've executed 160 projects and corporate transactions for renewable energy assets valued at over $20 billion in aggregate. We are wholly committed to the clean energy transition and aim to deliver exceptional services for financial institutions, infrastructure funds, strategic participants like IPPs and utilities, and leading global clean energy developers. Our team of experts across New York, San Francisco, and Baltimore help our clients break through the dynamic and evolving sustainability sector by simplifying project finance, M&A, and capital raising in special situations. We'll start with the purpose of a renewable energy deal model. For a renewable energy project, the model is the primary tool upon which financial decisions are made. If you're new to the industry, it's an excellent place to begin your learning. And if you're a more seasoned project developer or investor, it's likely the center of your framework for evaluating new opportunities and managing existing investments. Renewable energy models can often be very large and complex, so it's important to use best practice modeling, and Hayden will go into this in much more detail later in the session. I often get asked about why our models are so complicated and why we can't make them more simple. My response is that we must always keep it in mind to streamline where possible. But as the issues we face get more challenging for a project to hurdle or make sense to build, creative solutions are needed to maximize value and satisfy stakeholder needs. And that's where the complexity comes in. There are three primary uses of the financial model. The first use is to predict and measure a project's economic and accounting earnings. Now, I distinguish between the two because some investors are more focused on one versus the other. For example, publicly traded companies are focused on near-term accounting earnings. Economic earnings are calculated using cash flows and taxable income or loss. This is the type of earnings that we'll focus on today. The second use of the model is to help quantify risks to stakeholders. Note, there are also qualitative risks like reputation that stakeholders have that are not generally modeled. There are three time horizons for segmenting the risk to stakeholders, and these are development, construction, and operations. During development, two key risks to model are the technology that generates the electricity and the price of energy and environmental attributes. There'll be more to cover here on quantifying construction and operating risks when I talk about scenario and sensitivity analysis a bit later. Lastly, the model is used as a structuring tool to determine a project's capital stack. This can be also described as dividing up the pie. The optimal capital stack is that which maximizes value to stakeholders through allocation of risk and return. This is the use of the financial model that I personally enjoy the most. And for modeling geeks, it really shows and allows you to demonstrate creativity and apply quantitative methods to support your analysis. Ultimately, the final capital stack for a project will include some combination of stakeholders from equity, preferred equity, tax equity, mezzanine debt, or senior debt. To recap, we talked about three primary uses of the financial model. Ultimately, the model allows us to measure return, quantify risk, and optimize the stakeholder mix. Stakeholders have a variety of ways to measure the economic performance and risk of their investment. Let's talk first about the different types of stakeholders. Debt is the most senior stakeholder, and they take the first available dollars from a project's cash flow. Debt holders, or lenders, analyze metrics like maximum debt sizing, tenor, interest rate, debt service coverage ratio, and loan to value. Now, there's a twist here that many folks familiar with the industry know, that when tax equity is present in the capital structure, lenders almost always fall behind tax equity in the cash waterfall. This shift in structure is called back leverage. And while the cash priority is shifted to tax equity, the lender's investment metrics and risk analysis remains predominantly consistent with regular debt, or what we sometimes call front leverage. Tax equity, as just mentioned, when included in the capital structure, will have seniority in the cash waterfall. Tax equity is unique to U.S. renewables and is often the most efficient way to monetize tax credits earned by projects. And when I speak about tax equity today, it's in the context of a flipped partnership. There are other tax equity structures like inverted leases and sale leasebacks that are also used. Tax equity is typically concerned with metrics like tax flip date and tax flip rate and economic substance. While protected from many risks, tax equity must typically demonstrate some level of equity upside and downside in order to safely earn its tax credits. Equity is the last to receive cash in the project waterfall. After all the stakeholders have received their claims, equity will be able to observe the most upside and downside of the stakeholders. Equity is most interested in metrics like valuation, net present value, IRR, cash yield, and MOIC. Mezzanine debt and preferred equity are two additional classes of stakeholders that are often not present in U.S. renewables, but when structured effectively, they can add additional value to the capital stack. In summary, stakeholders rely on the financial model to measure key metrics that help them to make investment decisions like how much to invest, for how long, and at what price. A project's pro forma cash flow and taxable income reveal its expected economic health. Now, this is where we always begin our analysis. And here's where we're focused on economic earnings. Financial models typically aim to predict these earnings over a long time horizon, sometimes up to 45 years for a solar project. This is different than analyzing a publicly traded company where you typically might model 5 years of cash flow with the terminal value at the end. And the reason for this difference is that a large portion of project finance cash flows and taxable income are fixed through long-term contracts. The contracts serve to reduce uncertainty in these cash flows and allow the sponsor to take on risk to develop and construct a project. The development and construction of a project can take anywhere from 2 to 5 years to complete. And during this time, stakeholders are investing their capital. Accordingly, the financial model captures capital expenditures, construction draws and interest due, and any liquidated damages owed for construction delays. The operations of a typical project may span anywhere from 20 to 40 years, depending on the choice of technology and other site considerations like land rights and the weather of the location. Accordingly, the financial model will capture revenues, expenses, reserves, or major maintenance, and the financing structures like tax equity or debt.
Hi, Manish. There's one good question that's popped up here as well, which is how would this look different, this picture here, if this was a wind deal with PTC?
Yeah, sure. Very good question. With the PTC, what you would see is instead of the blue tall column at year 5 here, and year 5 doesn't mean year 5 of operations, it's at the beginning of operations. You'd see from year 5 to 15, you'd see a series of blue columns that are not as tall as that one, but a bit shorter, and those would be for the production tax credit. And while the ITC is eligible, while wind transactions are eligible for the ITC, we rarely ever see that on onshore wind. Great. So for the next series of charts, it's important for me to explain a few conventions I'll be using here. Yellow color will represent investment from capital providers, and this is a yellow line. Green will be used for project cash flow. Red will be used for project taxes, and this includes accelerated depreciation benefits. I've assumed maker's depreciation instead of 100% bonus depreciation that can also be elected for solar projects, and that's what's shown here. Makers is typically the convention that's used. Blue will be used for project tax credits that are earned at the start of operations, as I said, for solar projects.
So one more good question here, Manish, as well is any thoughts on how this graph would change when or if ITC was, say, discontinued? It's stepping down to 10% now, but if it were discontinued, any views on how this picture might look?
Yeah, the discontinuation of the ITC really would, there's obviously a lower credit here in the bar chart, and we're showing, we're not showing what the capital providers provide here. We'll go into that a bit later, and I think that would be a little more, if you could remind me, Hayden, to kind of touch on that when we go through the capital stack later, I can answer that one.
Sure.
Great. So when we analyze the NPV of what the capital expenditures ultimately provide by way of project cash flow, taxes, and tax credits, we can see that almost 30% of the project value is from tax credits, while the remaining value is from cash flow. The aggregate economic return to the sponsor or developer will depend on their timing of acquiring the project, the financing that's in place, and how the investment performs operationally. It's important to note that the spectrum of expected returns can be quite broad at the early stages of project development. Many potential projects will never reach the phases of construction and operations. The money spent on those projects will be sunk costs. Once a project reaches operations, a great deal of uncertainty has been removed. The net present value of the project is significantly higher than it was at the start of development. There's no longer a need to worry about permitting, obtaining interconnection rights, fighting with landowners, finding efficient sources of financing, or safely constructing the project. At this point, the key focus is on monitoring and managing the asset. Investors who acquire a project at or during operations will have a much narrower spectrum of return expectations. However, because those other risks have been borne by the developer, the level of expected returns is now lower. While the spectrum of expected returns is relatively constrained for projects acquired at this time, equity can influence these returns through active asset management and optimization. And Hayden, I know you'll touch on this later in the session. When you compare the expected net present value of a project at the start of development with that of a project at the start of operations, it demonstrates that a large portion of project's economic value can be realized during development. This difference in value is what drives developers into the market at various stages of the development spectrum. And in order to chase higher returns, pension and infrastructure funds are investing earlier in the development cycle or acquiring development platforms outright. Developers are realizing this economic value by successfully bringing early stage projects to completion and financing them with efficient sources of capital. Often, the most difficult source of capital to obtain is tax equity because of the limited universe of investors with sufficient ability to utilize tax credits. With tax equity, 99% of the tax credit can be monetized. Tax equity requires a minimal amount of cash flow, primarily for economic substance reasons. Tax equity will also monetize depreciation benefits, although this is often muted on solar projects due to complications arising from partnership outside bases. Debt will absorb the majority of a project's cash flow, providing a low cost match to stable contracted revenue. Equity will provide the remaining capital and will earn its return through cash flow offset partially by taxes due. And when you sum the value components of cash, taxes, and tax credits for the three stakeholders, they look slightly different than that for the project as a single entity. The reason is stakeholders have differing discount rates for these attributes. Tax equity values cash flow less than equity does, and vice versa for tax credits. So this might be a good point here to address the question that was asked earlier, Aidan, about the ITC if it's discontinued. And what we would see is a smaller component of tax equity. And one of the challenges that we deal with is how do you make tax equity work with such a small ITC? And you know, frankly, it is one of those challenges that is difficult because the traditional structures of flip partnerships have been done where the investment is typically around 35 to 40% from a tax equity provider of the full capital stack, and as you have a smaller component of ITC, more of their return is going to need to come from cash than it would from tax, and so I would suspect that there is either a shift in how these capital structures are done, or a new structure such as a sale leaseback that might prove to be more efficient.
That's great. Just a couple other questions that I think are probably worth touching on now. So keep the questions coming. There's some great ones. Just before I pose the questions, we'll answer as many as we can, but we have obviously a time constraint. For the questions we don't answer, we will put up on the back of this webinar sort of a list of Q&A with some of those responses. So thanks for that response. The next one, which is a really good one given the context of talking about IRRs, are you able to touch a little bit on the IRRs that we've been seeing in the last year in the US, and if you're sort of expecting any change in that in the coming 6 months to a year?
Well, Hayden, that's a bit of a loaded question here in the times that we're in, but I suspect that there, depending on the impact of COVID-19, I think that's the most important impact that's here in the near term. You know, we do expect to see some volatility in where these IRRs are coming out. There could be folks coming in at the same levels and some just out of the market temporarily. So that one is something that is very relevant, and I think we'd feel better about seeing how this plays out with our clients in the next coming weeks, and get back to you with a response on that.
Sure. Are you able to just touch on sort of just a rough range of IRRs for tax equity and sponsors broadly across the market over the last year?
Sure. So roughly what we're talking about here for tax equity on solar is in the call it 5 to 7% range for utility scale solar, and maybe a bit higher for C&I solar or residential solar. And then on the equity side, there's kind of quite a wide bit of range, and depending on the types of investor and when they're coming in, as I've shown here. And if we want to just talk about what's here in the range down below on the slide, the stable narrow band coming in at COD could be anywhere from the fives, high fives to maybe high sixes, and maybe a bit higher than that, depending on the asset and where it's located. And then you've got another yellow band here that is, call it another 100 or 150 basis points on that.
That's great. Thank you so much. Just one other question that's come up, asking to explain the difference between tax equity and just equity. There's not enough time to fully cover that now, but in the next webinar, we will talk a bit about that. And there's also a recent webinar that Pivotal 180 did with Norton Rose that covers that as well. And you can find it on the Pivotal 180 website. So thanks for the question. Fortunately, we can't cover the full details of that right now. Well,
great. I'll move on here to the next slide. And scenario and sensitivity analysis. And this is where advisors and investors spend most of their time in the financial model. Scenarios are potential choices or outcomes resulting from decisions made by stakeholders. Scenario analysis requires changing all the input variables at the same time. Early in the life of a project's development, there's a lot of uncertainty on how the economics will play out, and therefore there are a lot of scenarios to analyze, and sometimes this can be even hundreds of scenarios. Some examples of typical scenarios developers face are selection of offtake and technology. The financial model is critical for making key decisions like what price to contract power at and whether to select monocrystalline or polycrystalline panels. Other examples of scenarios are changing the composition of tax equity and debt in the capital structure or evaluating a purchase option case. Sensitivities are variables that impact expected results. Sensitivity analysis is performed by changing one variable at a time to observe the impact. Sensitivities can be segmented into categories. Two categories of sensitivities most commonly analyzed are market and performance factors. Market sensitivities are used to test an investment's impact from external market forces like merchant energy prices or inflation. Performance sensitivities are used to test an investment's impact from external physical forces like weather and internal factors dealing with plant operations. Production factors like P50 and P99 are the most commonly evaluated performance sensitivities. In summary, both scenario and sensitivity analysis are valuable tools used throughout the project's life. A tornado plot can tell a comprehensive story about an investment's risk exposure and upside potential. Plots often follow a convention where factors are stressed both upwards and downwards by the same amount to observe the impact on returns. The base case returns are shown in the diagram, but actual returns will fall somewhere within the spectrum shown here on the plot. And to answer your question a bit earlier, this could be indicative of a sponsor return on an investment. Now I'll hand it off to Hayden to walk through conversion of the deal model for asset management purposes, or pause for any other questions.
Thank you very much, Manish. That was great. There's a couple of questions coming through. Just given time, there's two things we will do. Manish will be responding to some of those via writing as I'm talking, so keep an eye on the Q&A box. Secondarily, we will also try and answer as many of those as we can through the back end of the webinar. And finally, we will be providing a Q&A list on the back of the webinar. So we'll send out sort of the questions and answers to what people have asked us. Okay, so what I have in front of us before we sort of talk about the conversion from a deal model to an operating model, just to put in perspective sort of what a best practice model looks and feels like. And so what I have on screen is a sort of what I consider a best practice model. This is actually from our renewable energy training course that we provide both in person and once we can, and online courses as well. This is not a tax equity model. Tax equity adds a little bit of complexity to models, which we cover in a separate course. And as Manish said, tax equity models are complicated because tax equity is complicated itself. So it does add some complexity. I want to touch on the basics of the best practice side here. We're not going to spend too much time on it. But what we have here really is a number of different sheets down the bottom. And you can see there's different colors. This, although I've clicked on it, is gray. That's an input sheet. The information flows from there to our blue calculation sheets, which flow out to our red output sheets. And I'll cover these each briefly. But the best practice principle here is try to minimize or not have too many tabs across your model. So if you can keep at least the number of tabs fitting on one screen, that's good. The more tabs you've got, the harder it is. Now, again, with tax equity, unfortunately, we need some additional tabs. But this is a typical layout of a model where our inputs flow through to sort of the operational calculations of our model, or our project level calculations. We have all our funding calculations grouped together, and often our tax calculations all grouped together as well. From a best practice standpoint, you can see we've used grouping. So on my input sheet here, I've grouped things up rather than having hidden rows. And if I open this up, you'll see there's a bunch of different colors. And just from a best practice standpoint, what's important to recognize is that we can use these colors in the spreadsheet you see now to define how a user interacts with a model. And so, for example, for us, we use something called styles. And here, if I go up to home, cell styles, you can see there's a bunch of different styles that I can apply in my model, and they all mean something to a user. And you don't have to use the colors we've used, obviously, and Cohn Reznick has their own colors, but what's important is that you're consistent with how you approach it. And so these cell styles are just like in Microsoft Word, you have header 1 and header 2. It's the same sort of thing. You predefine colors, formats, number styles. Now, we have a full video that's free on the Pivotal 180 website if you'd like to learn more. But here, the yellow cell means that they're input cells. So, for example, how long my construction duration is, how long my operations duration is, my construction cost contingency. If I'm early in my project, how many turbines do I have, or panels, and what's the nameplate capacity per turbine? And so the yellow cells, the input cells. And then, I'm very clear with, here's the label, operations date. There's a clear unit that's put there as well. So it makes it easy for the users to understand how they can use the model. What can they touch and what should they not? Now, these blue cells here are another style which we call a link, which just means it's a calculation, but it's not in the usual area of my model or calculations. So when we go across to our calculation sheets, you'll see that most of our calculations will start from column I. So if we do a calculation outside of that place, we just want to make it clear and obvious to the user that, well, we're doing a calculation here. Don't just go and hard code a value over it. You could break the model. So very clear use of styles. You'll also see on the input sheet that we have a bunch of different scenarios. So here there's just 4 scenarios. We have 4 different cases. There's a P50 case, a P99, and then we have some upside and downside cases, and much more on that in the following webinar and our white paper. But we need our model to have the ability to run sensitivities and scenarios. And so if I picked case 2, for example, here, I'm now picking the P99 case. That's the case that's active. And you can see I've highlighted that. I'm using conditional formatting to show that, yes, we're in case 2 now. Just be aware of that to the user. And it's now going to be picking up the values that I've selected in case 2. I selected case 3, for example, you can see our cost contingency here of 5% is now picking up the value from case 3. That's our P50 upside case. So we're using less cost contingency in this case. We're adding less to our construction costs. So we're just setting up a structure where this here is our particular scenarios and sensitivities, our different inputs based on the different case we're considering, such as my P50 or P99, or if my costs are higher, my costs are lower, whatever cases we come up with. I want this here, this column E, to pick up the relevant value from these cases here. And that flows through my model. So really, without going into the mechanics of this and how that works, what we need to have in these best practice models is a way just to pick easily between different sensitivities and scenarios. If you'd like to know how to actually do this layout, again, there's a free resource on the Pivotal 180 website, a webinar that was recorded earlier on how to create sensitivities and scenarios. Main thing, best practice, we need this ability. We're going to be running, as many showed, so many different cases to structure our project. What if this risk happened? What if that risk happened? So it's common to have much more than just 4 different cases. So it's got all the typical inputs you'd expect for a renewables project, through operation, through revenue, operating costs, variable costs, et cetera, through the project. That's our input sheet, and that flows across to an operation sheet. Operation sheet will include sort of the project operations. This includes our generation calculations, how much we are selling of our energy, or the sales under a PPA agreement, or selling to merchant energy. All our operating costs, accounts receivable, payable, any other things that are required in this model. And just to give you an example of sort of the look and feel of a best practice model here, you can see a number of things when I've opened up this section called selling energy. And this is a section where we're working out the total revenue, a portion being of it from PPA and a portion being from merchant. And so the PPA revenue, if I look at the formula for this, this is about the extent of any sort of formula in the model. There's going to be some that are more complicated, particularly when grouping up things into annual outputs. And sometimes it's unavoidable to have a longer sort of formula. But what we're trying to do here is keep the formula to less than the length of the formula bar, and ideally to within half. So the more formula you've got that are just multiplying, subtraction, division, and subtraction, the better. So we try and limit the formulas to be as simple as possible. We also have other styles in here that are really important to the user. So for example, this total revenue line with the line above it means it's the sum of everything directly above it. So I know this should be the sum of everything of my PPA revenue, merchant revenue. I also have line totals here. So I'm just clearly showing how what the total PPA revenue is across the life of the project. So they're just tips and tricks on making it easy for the user to understand how things are working. And these models are long. You're going across 30 or 35 years, this one on a quarterly basis. So line totals tell you a huge amount. An example of that is, here is my PPA period. It's got an input back in the input sheet of 20 years. And you can see the total number of quarters has a flag. So it's a 1-0 flag. If I'm in a PPA period, show a 1, otherwise a 0. And in a PPA period, if I sum that whole row up, I get a total of 80. And we know that's right because 20 years times 4 quarters, 4 quarters per year gives us 80 quarters. So that line total is really, really important to us. I'm not going to go through all the calculations. The funding sheet has what needs to be included there. So how to size and structure debt, calculate your key output ratios, typically the DSCR in the context of the US, DSCR and LLCR internationally, the loan life coverage ratio and debt service coverage ratio. Our debt service reserve account, how to fund construction, we need to work at distributions. And on our tax and return sheet that we have, we calculate all of our depreciation, all of our tax calculations to work out the ultimate post-tax returns to the different parties of the transaction. Where possible, we always try and include all of our three-way statements. So our cash flow waterfall or cash flow statement at times as well, our income statement and our balance sheet. We make sure that the balance sheet balances. It's important to always have that check in a model. So this is quarterly because our model is done on a quarterly basis. In addition, we have annual summaries, and this is just grouping things up into annual numbers because for decision-making purposes, it's easier often to see 30 years of annual numbers rather than 120 quarters. And finally, we have our dashboard. And our dashboard is important to us because really what's the purpose of the financial model? It's to do the things that Manish mentioned, but it ultimately is to make a decision. And so it has to tell a story to the senior people involved in the transaction. Do we invest in this? Do we not? And if I do, what do I get out of this project? So we can see here I've got some key returns up the top. We've got our sources and uses, which is our total amount of stuff we need to fund as our uses, and our sources is our total debt and equity that we're putting in the project, tax equity if we need that. We've got our key outputs for all our debt metrics. And then we have a number of things that just show the operations. And I think some financial models, people sort of omit the core operations of the project, but we do need to show that. We need to show what is the installed capacity, my capacity factors, my gross generation, the price we're selling energy for, the total costs. So we need to show the things that tell the story best to you. Every project is different, but there's some broad things that are pretty common across renewable energy transactions, and these are certainly some of those. Clearly, we need to show the cash flow waterfall, who's getting money when, and graphs, pictures tell 1,000 words. So we can see here the loan balance going over time with the principal interest, the benefits to an efficient taxpayer or tax equity. What benefits are they getting? We can see the revenue. And here, this is a lovely graph. I love this because I think it's kind of representative of how we're seeing things in the world. Here is our PPA revenue. And you can see this big jump up in merchant revenue. And so that picture tells you, is this right? Like, does that make sense? Is this a thing I should be questioning more heavily? And maybe this is right for your assumptions, but I certainly, over the last couple of years, have seen a big increase in the step up from PPA prices up into people's merchant assumptions on the back end of the project. And this blue area represents a very large portion of equities returns. So without going into detail of that, the importance of these graphs makes you wonder and think, does this make sense to me? That's what your senior decision makers need. And finally, we have all our different outputs, our sensitivity. So this is, you created a data table. These are all of the outputs for our model for every single different scenario or sensitivity. So what are my returns? What are my, what's my debt contribution, my equity contribution? Whatever you need to see in the model, you need to see that on your output page as well. And I think for me, what I love to see is if I can print off the input sheet and the output sheet, or the dashboard as I've called it, and I can understand broadly the transaction, I've done my job well. And that means if you're the analyst or an associate on the project and you're presenting this to your VP or director, if you can bear that in mind and achieve that, then you're doing a really good job. And I think finally, make sure it tells a story. So if there's a particular story you want to tell and say that this is a great project from a operational standpoint, stick the key outputs out, the metrics, and think of things like dollar per megawatt or dollar per megawatt hour, anything you can that sort of shows those things that highlight the benefits of your project. And I see there's a couple of questions here, which I'll answer as I jump across now to the next part of how to convert a model to an operating model. One of the questions is this model available for purchase? Not on its own. It's included in the Pivotal 180 paid courses. So if you'd like to at model, you can just join one of our courses. So it's free with the course. Okay, so moving to the next piece here, which is, so there is one more question about how to show multiple scenarios and one output in the model at the same time. So the question is this: what's the best way to show multiple scenarios and one output in the model at the same time, rather than having to go and manually switch between different scenarios in the control tab? The best way of doing that is using something called data tables. If you'd like to know how best to do that, we have the free webinar on Pivotal 180 website, which covers how to create scenarios and sensitivities, including data tables. If that's not your question, feel free to post another one. Okay, so let's move back into the slides, and remember that the transaction model, as Manish guided us through, was the transaction model is primarily used to structure an investment. And what I mean by that is, how much will each party contribute in return for what they will receive out of the project? So for example, for debt, they're going to size the amount of debt they're willing to put in, and they're going to work out their repayments, typically based on a sculpted repayment methodology. And so that transaction model is going to be able to work all of that out, but also run just possibly hundreds of scenarios and sensitivities over the life of the project. But that changes. Once we go beyond the deal, we're kind of now into what I'd sort of say is the real part of the project. We've finished the deal, now we've actually got to make it work. And so what does the asset management model do? It does something a little bit different. It's not structuring and sizing the investment, it's doing something else. What it's doing is it's tracking project performance. So is our project cash flow sufficient to cover our costs? Do we have enough cash or working capital in the business, perhaps? Sort of the usual things that any finance team on a project would be considering. The other thing we would see is we would need to bridge the valuation now between the transaction. And what I mean by bridge is compare the valuation based on actual performance of the project, what we expected the project, or how we expected the project to perform when we hit financial close. And those could be really different in the end. We see many of those cases, but we need to compare the valuation. What worked and what didn't. We may also review shorter term performance of the project over the last year versus our last year's detailed budget. And I'll explain budget shortly, but we're sort of looking at short term performance. We may also track cash flow of the project in total versus, again, what we thought of all of the total project cash flows when we hit financial close. And that model that we had at financial close is quite often called the base case. But we will also be considering new investment cases. There's no question to that. So some of those investment cases could be something like refinancing the asset because there's a lower cost of financing. We can improve our valuation. We could be looking at selling the asset to someone with, maybe a different view of value, perhaps a lower cost of capital to ourselves. Could look at repowering the asset, expansion of the project. And that little part, I guess, this consideration of new investment cases lends itself a little bit more towards a transaction model. But typically, from an analysis standpoint, it's a smaller portion of what the asset management model itself is doing. So one thing I'd also like to mention here is that majority of sort of asset management models are also developed in Excel. And that's the common way of doing it. But there are alternatives out there, and one that I'm aware of in the US for renewables, for example, is ABC. They're used quite frequently around the world as well. So what's the common approach into how people deal with this? What do they actually do when they need to create an asset management model? And look, here's the not so good approach. The deal's done. We can party. Let's send the model across to the operations team. The deal team might even email the model to the asset manager, who may have had almost no involvement in the initial transaction. They may have had some, but it's, we'd like to call it perfect hospital pass, as in it's no longer the problem of the deal team. The deal team just said, here's the model, go for it. And that's clearly not good. And bear in mind that the asset manager itself, they might have quite a different skill set to the transaction people. So an asset manager could be an accountant, could be an engineer, could also be a finance person, but regardless, their skill set is a little bit different to transaction people. Perhaps the asset manager has more experience in operating projects or project governance or the management of cash flow interperiod over every month of a project. But it's quite common, and I'm generalizing, but I'd say it's a pretty good generalization, is often the asset managers themselves, because of their other skill set, don't have the same skill level with financial modeling as the deal teams, because they just don't spend the same amount of time creating the models. We all have our roles to play, and we need to be mindful of these different skill gaps between parties. And likewise, the deal team just doesn't have the same skills in asset management. So the next happens is they convert the transaction model to an asset management model. And here's what often happens. First of all, they hard code over historic data. And what I mean by that, historic data, as we roll the model forward, or let's say we're now, the deal closed at the end of 2019, and by July of 2020, we've now got 6 months of historic information that needs to be recorded somewhere. And instead of creating a dynamic model, some people will go and hard code or type numbers over previous formula itself, which is hard to trace. It's hard to find where things come from, and it's dangerous because some of the cells, other cells in the model flow into areas that are important, and you've just hard coded over something that is which breaks the model. They may also update the timing resolution. Asset management team clearly needs to manage cash flow, and so often they need a model with a shorter time period. Transaction models can be quarterly or even semi-annual, and so the asset management team might need a monthly model. What they may also do is just go, hey, look, we've got this existing model. There's all these calculations about how to size debt and to optimize the tax equity itself. There's these macros. Let's just leave those in there, because it's easy. I don't have to touch it. and B, I honestly have no idea how it works anyway. But this itself creates risk, both from a financial modeling standpoint, but also sort of from a personnel standpoint. What it means is the asset manager is now a little bit scared to touch the model itself. They sort of see it as a black box, and they're not really sure the calculations derive from it. If they're brave, they may try and hide the calculations, hoping they're not so important. But it's not good if the asset manager doesn't really understand the inner workings of the financial model. It's going to be a lot less dynamic than it was before. We don't need all the debt sizing. They need to understand fundamentally the build-up of the revenues and the cost and every aspect of the model. They're managing this project. So you can see it's a kind of a scary proposition. And to make things worse, sometimes, at least in US renewables, there's actually 3 models: tax equity model, a debt model, and a sponsor model, that are all to be used for reporting for different purposes. For tax equity, to review the flip date; for sponsors, for the same thing, or to look at refinancing; and for debt, to monitor the covenants. And one of the problems is, I've seen this before in US renewables, the models don't even reconcile to each other. So they're giving different results, which is a very scary thought. And obviously one of the benefits of using a strong advisor like Manish at Cohn Reznick is they often have a very good model that all of the parties actually agree to upfront, so you don't end up with 3 models. So that's the bad approach, and not a good way to live. So here's the alternative, and this is sort of very, very common in infrastructure, and I think it's time for renewables to follow along here. And what infrastructure people do in core infrastructure typically is they build a new model that's suited to asset management. And it's suited to asset management, not just for the asset manager, but to all stakeholders. And so first of all, it's going to be easy to update. And by that, I mean, it's going to be quick. And I'll show you some of the functionality that's required shortly, but it has only the outputs and functionality required for all parties now, for all stakeholders. So it does need some engagement between, not just the asset manager, but potentially between a number of sponsors or the lender or the tax equity investor as well. But it's really a fit for purpose model. And it's reconciled to something called the on-record model. So I just got a question asking what's my definition of infrastructure here. When I'm talking about this here, I'm talking about core infrastructure. So if you look at particularly the P3 world, this is very, very common in that space. So the on-record financial model is really important because it's the model that's referred to in our deal documents, such as the loan agreement or operating agreement. The documents specifically refer to this base case model. So for example, if a DSCR is breached, the loan documents could specify a corresponding mechanism that occurs if that DSCR is breached, such as a lockup. And the loan agreement will specifically refer to the base case model. And it could say something like, if the DSCR is breached in the base case model, XYZ happens. So the actual calculation of the model are really important to all stakeholders. The model is not just for the deal. That model is being referenced in all of our loan documents. So it is really important. We also need to provide training to the asset managers. So for example, we should make sure they understand financial modeling. So just the basics of financial modeling, how do they create sensitivities and scenarios for themselves? They don't need to necessarily learn how to structure debt in the same way, but they need to know how to build up a basic model. And I think if they have that confidence and they've built a model themselves, they're better at modifying models too. But more specifically, we need to make sure they get real training in the use of this model and in the deal itself. And that handover should be quite extensive. And I think that's an area where I've seen errors or issues occur in the past. And I've had to get involved in sort of rebuild a new model and educate the asset manager and the deal team on this process itself. But another one that's really important here is we want to look at standardizing models. And if you want to think about this, we're really doing it to reduce risk and save time. So think about a common graph that you always look at. If you always saw one graph showing the total benefits that you get from a project, you're going to notice if something looks different. You're familiar with that graph. So it's a risk reduction. You notice something quickly that shouldn't be there, which is really powerful. And of course, it saves you time because you can see that issue earlier, but more importantly, you can familiarize yourself with new projects quickly because you're just used to seeing certain output sheets or certain graphs. You don't have to figure out an entirely new model built by a different advisor or a different shareholder partner for this project. So your asset management team gets more efficient and they're reducing risk. In saying that, there is an alternative way of thinking. And look, there's a variation here where the deal team itself creates the asset management model rather than the asset manager themselves. And that's helpful, but often the deal team members are not equipped to do this sort of modeling. And I can tell you this because I started asset management modeling much after I was doing deal modeling, and I learned the hard way. It's really hard. It's not the same thing as deal modeling. You've got to have a different mindset. But no matter what, the asset manager should be involved. So,
Hayden, just to interject a couple of questions that came up on the last slide. One is, what is your definition of infrastructure?
So my definition of infrastructure in that context, where I see this sort of work happening, this rebuilding of models, certainly in the P3 space or PPP, public-private partnership space, that's what I was really referring to that. But look, I'd also say internationally, when you look into some of the big international investors out of the US, it's quite a common process as well, even in renewables. But in the US, on the renewable side, I would see that process, it's less common.
Thank you. And also there's another question about, is there a movement to shift out of Excel to other software, for example, Python, for creating models? And then the second part to that question is AI slowly gaining the capacity to replace analysts during the model creation process?
Really good question. Is there a shift to move out of Excel? So is there a movement? Yes. Is that happening? Less than you might think, partly because one of the things about project finance is so many people are looking at this model. So your tax equity investors, your lenders, a number of different sponsors. So everybody needs access to the model, and everybody needs to understand the underlying details of the structure of the calculations itself. So for that reason, a lot of sponsors will push back on using any sort of software itself. But people do use it, and I think there are some benefits to that. But the biggest restriction at the moment, from at least my impression, is everybody wants to look under the hood and everyone knows Excel compared to another software. Is AI slowly gaining capacity? AI models, but I'm sure that is something that's coming in the near future. I saw there's one other question here. Which team should be building the asset management model? Third party with inputs from the deal team and asset manager, or should the asset manager themselves build it? Look, it just depends on your ability to do it. I mean, I guess I have a view that sponsors can build models. That's really good. It's your asset, but look, the skill set, especially in tax equity, it's hard. And so if you don't have that skill set, I would strongly recommend outsourcing it, at least for the first couple, until you're really familiar with it and you build up your own team capability. But I would say that's the best way. Okay, so the question is, do you build or simplify the model? And there's, I guess there's two schools of thought here. So if you look at the advantages, I would say, in my experience, building a new model is almost always quick. And I've learned this the hard way. I've been convinced, can you just use our model and modify it? And most of the time when I've done that, I've learned to regret it. But sometimes it can be quicker to modify an existing model. But when committing the time to build a new model, there's a renewed focus and desire to ensure the model achieves its objectives, particularly if you're outsourcing and paying someone to do that. It doesn't mean it's necessarily slow to rebuild, but there's a mindset change. And also the asset manager themselves tends to lead that process. They get what they really need out of the project, and they're now fully invested in this process, which will, as you'll see in a second, will help them save time going forward. All stakeholders need to be involved in that process. And the truth is, many transaction models are not well suited to being converted to an asset management model, especially bad ones. And finally, the discussion between asset management teams and deal teams in the process is just not a good educational exercise. So it is a good educational exercise, and that both the deal team and asset management team learn from each other, and it helps to develop that positive relationship between the teams. You can get that with modifying existing model too, but I'd say generally it's this mindset of, hey, I'm getting someone else to build this model, or we're committing this time. Let's do it right. Clearly, if you're using a great model from someone like Manesh, with a great Cohn Reznick model, it's going to be easier to modify than a less well-built model. And so, can you simplify a model? Absolutely. I've done that before, and I have done it plenty of times without regretting it, but less than you may think. And one common argument against rebuilding is that the transaction model is the on-record model. It's a really important document. And that's correct. And to rebuild the model, the sponsors will need permission from all the other stakeholders, lenders and tax equity. That still actually applies even if you're modifying the existing model, because the on-record model is a specific version of the model used at financial close. So you would go down the simplifying model route if you've got a well-built model with an experienced modeler. If they can do this, this could be much, much quicker as a process. So you only do this if you've really done this before and you know what you're doing. And, again, someone like Manish can do that. The next piece to it is, regardless of which way we do it, we're going to have to reconcile to the on-record model. What I mean by reconciling is we're comparing the cash flows and the valuation between the transaction model and our new asset management model, be it a rebuilt one or a modified one. And this is often the slowest and most painful part of this whole process, particularly if you're changing a model from, say, quarterly to monthly. And we need to reconcile every line. And admittedly, with a new model, that's going to be slower because we're starting from scratch. So we're just building up revenue from scratch, and therefore you're having to reconcile every single line. Whereas if you're rebuilding a model, you might just be looking at the things that have changed. So there's less reconciliation in using a simplifying a model. But finally, I think this is important. Rebuilding a model is often by far the best way of finding errors itself. So with that background, regardless if you're rebuilding a model or modifying it, I'm going to go through sort of the key aspects of it and some of the technical aspects behind that. Starting with setting up the timing structure of an asset management model. It's different to a transaction model. And this one here, just for the demonstration purposes, is cut across at 7 quarters. Each period of this model is quarterly. So from January to March, April to June, July to September. And we've got 3 different periods: historic, budget, and forecast period. The historic period is often called the actuals period. That's sort of terminology that's used at least in the modeling community, but it's all the stuff that's in the past. So right now, what this represents is we are at the beginning of April 2020, and our historic period, we hit financial close at the end of 2019, and we've now had 1 quarter of historics itself. And we've used binary flags here, this 1-0 concept again, to show when we're in a historic period. And we just use conditional formatting to pop out that 1 so you can clearly see visually when my historic period is. And this is using flags. And again, there's a free resource on Pivotal's 180's website to understand how to do that. But it clearly shows me when I'm in an historic period. So in addition to that, the project's finance team will be preparing some sort of shorter term cash flow forecast. And these are typically for the next 12 months or perhaps the next calendar year, but it could be a period up to 5 years. And typically they're doing that on a monthly time frame. They're looking at cash flows on a monthly basis to reflect seasonality, for example. And in our case, what we have done is from the historic period, the next 12 months or 4 quarters is that budget period. That's the period where there's going to be more detailed numbers coming from our finance team. From there, we have a forecast period, and this is just the normal cash flow calculations that were in our model in the first place. And that starts at the end of our budget period itself. So we're really replacing in the April 2022, 31st March 2021, that 1 year, instead of using the forecast calculations, we're going to instead use more detailed calculation from our budget, which comes from our finance team. And so this represents the best forecast of cash flow at the current point in time. So it's really saying, look, let's not just trust what our model does in the first year. Let's do more detailed numbers and use those for the first year. The next part is we need this to be easy to update. So I've got this yellow cell, this assumption here, which is showing the period of which is the end of my historic period. So that's the 31st of March 2020. So my budget period starts the next period, 1st of April 2020. And that's an input. And this can be done with a drop down or data validation. Again, that's covered on free resource on Pivotal 180's website. And really here, it's just you want to pick between an end period shown in our model. So do I want this my historic period to end on the 31st of March 2020, the 30th of June 2020, 30 September 2020, and so on and so forth. And so we want that to be flexible. And so if I change that to the 30th of June, we can see that it just automatically moves my flags out. It moves my timing of my model so I can clearly see that now I've rolled the model forward, as we call this. So rolling forward being I've updated the historic date to be in a future period from what it was before. And you can see my budget period now goes for a year from that point in time, and my forecast period starts even later. So knowing that we've got these three different periods, and not every project has a budget period, but it certainly has a historic period, we require historic numbers. And the big question is, which historic values do we need in our model? And there's two schools of thought. The first one is, if you mostly just care about future cash flow, historic inputs can be limited to items that only drive the future cash flows or impact the valuation. And so an example of this is the balance of your accounts receivable. That balance of accounts receivable this period is cash that you're probably going to get next month or in the next few months. So you need to know that balance because it's something that's going to affect your cash flow going forward. But you can ignore items that don't drive future cash flow. So, a fixed cost from 2 or 3 years ago, you don't need that. But you do need some opening balance sheet items, for example, in that historic inputs. Others, however, want to see all of their historic data in the model. So stakeholders may want to see output sheets that show historic cash flows and the budget period and forecasts themselves. So on the output sheet, rather than have, let's say you've rolled the model forward, you've had 2 years of operations, your output sheet, if it's just linked to your initial calculations, is just showing your initial forecast. And so if they want to replace that initial forecast for those 2 years with historic data, you need to add all that historic data into the model itself. And for that case, we clearly need those input values, which means more detail in the model. And the more historic data we've got, the more complexity. So assuming, for example, we just want to see the minimum items to drive the cash flow forecast, some examples of what we need are shown on screen. So we need opening balances of, for example, our debt balance, our cash balance that we can release maybe next period, our accounts receivable, our maintenance reserve account, which maybe we can let cash go next period. We need to know what's in there when we start our calculations next period. What's our opening tax basis for depreciation, or our current net operating losses, or what's in our partnership accounts or distributions? So we need some things, a sort of a minimum level of detail to drive the future cash flows. But as I mentioned, we could also add in much more historic data, and that could be every single line of revenue or each input even that drives revenue. So be careful here. I've learned the hard way again, and trust me, simple is key. If you don't need something in the model, don't add it. Too many lines of historic inputs is hard, not just from a technical modeling standpoint, but I've been in many situations where I've developed a model that functionally could add every single historic item, but the sponsor couldn't actually get the data itself. So one of the first things you need to decide is, what do we like to include in historics, and can we actually get that data? And I've seen many situations where people can't find the data itself. So just for a second, assume, so we're now in our calculation sheet. So we're across in our calculation sheet. We know we've got to have some inputs, so I'll come back to that. And presume for a minute the model needs to show the historic, a budget, and a forecast revenue. And all of those values will flow all the way across to our output sheet. So output sheet will include not just the initial forecast, it's going to have our actual historic values, our budget values, and our forecast values. So our best guess of future cash flows as well. And there's many ways of doing this, and I'll show you this first way. But I've broken down the 3 lines. So we've got historic revenue, budget period revenue, and forecast revenue on 3 separate lines with line totals. And what you can see here, what's great about this is the calculations clearly line up with a flag. So my historic revenue lines up nicely with the historic period. My budget revenue lines up nicely with my budget flags, and my forecast revenue lines up with my forecast flag. So I can just look at that and say, I'm pretty sure that's correct. And so you can see that's just an easy way for users to understand the model. And typically it's the best way from a clarity standpoint to show these on 3 separate lines. However, if you've got many, many lines in a model and many, many lines of revenues and costs, and for every line of revenue, every cost, you added 3 lines for them, you can see that the model is just going to get really, really big. So an alternative would be to, instead of having these 3 lines, is to do a calculation in total revenue that does the same thing except in 1 line. It makes the formula much bigger, which is not so good, but in a model with every single line having historics, that can be much cleaner than just having a model that's huge because you've got 3 lines for every, or 4 lines for every 1 line you had before. And these calculations here, what I said earlier is sometimes people hard code these values, the historic values, for example, and we don't want that. So instead of hard coding our historic values and our budget values, we will link them back to some sort of calculation sheet. So where do we link back to? Typically with these models, we create a separate input sheet. And this is looking just like the model I showed earlier on. We've got an actuals input sheet. So we typically create some sort of separate input sheet for this. And that input sheet is structured differently to how you'd see a normal input sheet structured, in that it's set up such that it has the exact same timing resolution as our calculation sheets. So for example, if this quarter, January to March 2020, were column K on my calculation sheets, it's going to be column K on my input sheet. So when I link or connect my calculation sheets back to my input sheet, it's just a direct link. So it's really simple. If this was, say, K15, my calculation sheet would just link directly to K15. And you can see that I've used some sort of conditional formatting here, so the user knows when they should go and put in values. In this case, the first 2 quarters of the model to June 2020 are my historic period. So I've populated historic revenue values in here. But what I instead have is I've put down my revenue below historic revenues. So this is my historics. My budget line is directly beneath it. And what's shown here is the values for the budget period. We can see there's a value of 5.10 in June 2020, and that was an input when the budget period started on the 1st of April. So just presume that I put that value in when I had this date set back to March 20. It's no longer going to be flowing through my calculations, but it's here as an input. And what's good about this is I can just clearly see my difference between what I thought I would get, that was my budget, and what I got historically. And so when I input the new budget value in here, it's going to be some food for thought. Like I thought I was going to get 5.1, but I only got 5.05. So seeing them right beside each other is hugely powerful to me. So that's our inputs for cash, but we also might need some inputs for our historic balance sheet. And it's going to be in the same input sheet. It's the same timing resolution again. Recognize first that project finance models build up cash flows that generate the income statement and balance sheet. In our case, it's a very, very simple balance sheet. We don't typically use a balance sheet to back calculate revenue. Our revenue is calculated from first principles. So if, for example, I'd included all of my historic revenues, my costs, my depreciation, etc., in the model, these historic values I would not need to populate. They should still be calculated based off my historic values that I put into my model. So I wouldn't need to populate an historic balance sheet. However, if we decided that we only wanted to put in historic model information in our model that drives the future forecast, we didn't care about our output sheet showing historic data, we could choose not to include historic revenue, cost, debt, or depreciation in the model. And if that's the case, Well, our historic balance sheet will not have been calculated, which means we have to add inputs for historic balance sheet items. And these are the items that drive future cash flows, like the accounts receivable or debt size. In addition to that, we would also need some other balances which aren't accounting balance sheet items, such as the tax basis of our project. So it depends on if you're including all the historic data or not in your model or cash flows. That dictates, do you need historic balance sheet inputs or not? So just a thought on that is, I showed a really simple balance sheet on the last slide, and it was oversimplified to demonstrate a point, but the principle of keeping it simple is important. And it's common to develop a three-way financial statement asset management models. And in fact, I would strongly recommend it, but the level of detail required is far, far less than the audited financial statements of the company. And all of a sudden in asset management mode, people are asking, well, the asset managers are probably quite familiar with audited financial statements. They're asking, can we have our model include that as well? But that's often too much detail in these asset management models. And so the model financial statements could be structured could be structured such that they're similar to the audited financial statements, but not exactly the same. And we might also have to make the balance sheet or the financial statements in accordance with generally accepted accounting principles, or GAAP, or possibly international financial reporting statements. But just recognize, commonly the level of detail in audited financial statements does not match the model. So we've somehow got to bridge the gap between those two, and it can be challenging as well. And to do that, we do something called mapping trial balances, which I'll cover now. So what do I mean by mapping trial balances? First of all, we create a separate sheet to be our model called mapping. And the challenge is this. As an example, on our balance sheet I showed a second ago, we had $6 million of debt on our balance sheet. But let's just presume that came from three separate lenders, X, Y, A, B, and PB Bank. The accountants may record this as three separate items in the accounts for their purposes. Perhaps they pay them separately and they want to record this fact. And each of those balances is represented individually, and this is what we call a trial balance. It's a download from an accounting system. Just a fancy word for balance downloaded from an accounting system. And each trial balance is listed by its own discrete code. And I've made some up here. And we know that all of these bits of debt, they are part of our total debt, but it's broken up into three separate loans in our accounting system. And the same would go for any other balance, maybe your tax basis or book basis for depreciation. And most accounting software can export the trial balances directly into Excel, into our mapping sheet, just with a click of a button. And they can do this every time the information is required. So 30th of June 20 is shown here, but you can have another column for when they download the period ending September 2020. And what our exercise is that we have to do in the financial model is to map these particular trial balances to our actual balance sheet, which is the simplified version of the balance sheet. And so in our balance sheet, we have three places that we could map these trial balances to. In our balance sheet, if you recall, we had PP&E, debt, and paid-in capital. That was it, really simple. So we add a drop-down menu here that would have an option to choose between debt, PP&E, or paid-in capital, and it's as simple as that. The question is, the next thing we have to do is we have to group that up into the relevant categories on our balance sheet, again being PP&E, debt, and paid-in capital. And we can do that with a function such as the SUMIF function. We SUMIF this whole range to pick up the relevant items that group into each of the items on my balance sheet, however many those are. So this is dropped down from our accounting system with a relative respective trial balances. I decide where those trial balances fit on our balance sheet, and then we group them up into the relevant items for our balance sheet. And these trial balances from a best practice standpoint should not change. It's common to see them added to over time, but hopefully they don't change too much. So every time they put new values down, you don't have to redo this selection of the reference itself. And the next question is, where do we take this stuff? And we need to put this information on our historic balance sheet. So we've calculated this on a mapping sheet on a separate tab. And this was our balance sheet before with just hard-coded historic values. Instead, if we had this mapping, we would link this to our mapping sheet, directly picking up our PP&E $6 million that we just calculated. So what's great about that is we're linking to a mapping sheet and we've got a clear record of where our historic data came from. So the process is this: we change the model start date. It should just be automatic, easy to do. We add any new budget inputs if they're applicable. And we download and map the trial balances for our historic information. And sometimes it doesn't include everything, so we may need to put some other inputs in, but it should be a very automated process from an input standpoint. Checking it is a different story. And what this should do is save you a huge amount of time, but also provide a basis for how inputs came from. And the true, I found typically you can save days at the end of a month from a inputting perspective. So remember, another main objective is to record how a project performs, and we call this variance analysis, comparing current cash flows to base case financial close model, or perhaps even last quarter's valuation. And it's important, it's common to compare not only the cash flows, but also the NPV itself. So we may compare the NPV of the project at financial close, NPV now, or back at time equals zero, but based on historic cash flows that have occurred to date, any future budgeted cash flows and forecast we have now. That's really, really common. Or we may compare the valuation as of today's date versus what it was at financial close. And Manish will talk about that in a second. But variance analysis is typically a separate sheet, given it's a really important sheet, and it's often labeled as something called a delta sheet. So again, another sheet. And this is how it will typically look. It's the same time and resolution again. What I've got here is my historic and forecast revenue. This is the calculations in my current model based on today. So these are my current calculations. Immediately beneath that, I've got the assumption cell. These are hard-coded values of whatever model I'm comparing to. You could link it to another model, but that's typically quite dangerous. So these are hard-coded values. What I have beneath that is the delta between them. So I'm looking at what was my initial forecast cash flows versus now, and you can see I've got less cash flows than I expected. And I've got a delta in a percentage standpoint. It's good to sort of quantify things with percentages. But again, this is a short example. In a full model with 30 years or 35 years of cash flows, it's hard to see the overall impact. So we include a total delta, what's a total percentage delta, and more importantly, we add an NPV difference at the relevant discount rate. So we can look at what's the difference in the NPV just due to revenue on its own. And this comparison is important. It's and powerful to inform future decisions itself. And you could do this variance on every single line in the model, or just ones that you deem to be critical, such as cash available for debt service or distributions itself. And it's up to you as the level of detail you require. This is a separate sheet, and we're showing each of the line items that we care about and what's the difference between what we have now versus what we forecast. And once we've got that, really the next step is to create a graph. And here's the graph of the revenue. Here's our historic and forecast revenue. This is what we're actually getting. And this is what we initially thought we would get. And pictures tell 1,000 words. It's what the senior people look at. And your first question you look at, as a senior person, you're not looking at 35 years of cash flow. You just go, why are we not performing as I expected to? And do we really expect this to catch back up in March 21 to this, our initial forecast, or should we actually be more conservative now? And before I now hand back to Manish, the final comment is that deal team members should get involved in the asset management to some degree. And at a minimum, they should be understanding the reason for the difference in cash flow and valuation of the project from what they thought it was going to be at financial close to what it actually is. Because if something went wrong, they should know, and hopefully they can use it as a learning experience on their next deal itself. So with that, I'll now pass back to Manish to take over.
Thanks for that, Hayden. Very impressive stuff. And I know we're getting towards the end of the presentation here, so we're almost through, and really good stuff, Hayden. Thanks for walking through those details. Just to summarize here, an equity bridging chart is another key chart that can be used to graphically show the impact of various factors on valuation. Valuation changes can be attributed to variations in performance due to internal and external factors. as well as retained earnings that are either reinvested or distributed to shareholders. In this example, and it's example only shown here, we see lower than expected merchant energy pricing is the largest factor in reducing valuation, and it's the largest red bar in the chart, while debt refinancing is the largest factor in increasing valuation, and it is the largest green item in the chart here. And with that, I'll hand it back to you, Hayden, to lead us through the takeaways.
Well, so I know we're running out of time here. We might go a few minutes over. I hope that's okay, and appreciate everyone sticking around. But really, what are the key takeaways? First of all, the asset management modeling and transaction modeling, they're really different. They're different skill sets. I've learned the pain of going from a deal world into asset management. It's challenging. So, and don't take shortcuts. Don't hard code over things because you think, look, it's fine and we'll deal with it later. It's painful. So do things the right way up front. Transaction models, remember, are there to structure and size deals, whereas asset management models are more about tracking performance, looking at how we can improve value and providing clear explanations of why things are occurring or not occurring as we planned. And look, I would seek advice if you have not done this before, either by hiring someone, getting an expert advisor, or upskilling yourselves in how to do it. And look, I'd make sure you do train your team. If you've got the skills in-house, train your people in-house. Go on a training course. Ask your advisors to provide a bit of support to you as well. It is a different world, and people underestimate the time required to actually do this work. It is heavy lifting to create the asset management models. As I mentioned, there's a couple of follow-ons. First, our next webinar with Cohn Reznick is on tax equity itself and the risks. That's a much higher level thing than going into details of calculations today, but it's going to be very insightful, and we're really looking forward to that one as well. We were doing a white paper on the sensitivities and scenarios in financial models to be really clear about what the main ones are in renewables. We will also put together a list of the questions and answers in a blog on the back of this webinar itself as well. So you'll have all of that. And this video will be available to anybody in a couple of days. We'll make that available so you can look at the video in your own time and continue to post questions. There's no problem doing that. Just to wrap up, I've mentioned training a few times, and I think Pivotal 180, myself and other founders, Alison Leckie and Dan Gross, have all come from backgrounds of either transacting or managing assets ourselves. And so we provide online training. So if you'd like to build a model from scratch, we have our renewables course that's online. You can buy that directly. A complete model from start. It goes through not only the modeling, but also how do you understand loan agreements? How do you understand what's in a PPA agreement? What are the commercial considerations? So that's a course is available now. We also provide in-person training, either public courses like I'm showing here where anybody can sign up. We've cancelled all the April, May courses. The moment we're scheduling early June. It depends on what's happening with COVID-19. They might be pushed out or delayed as well, but we hope not. And we also provide very, very tailored training. So we come to organizations, and the country you're in, we can specifically tailor the course to a particular deal you're doing right now. So actually build a model based on your current deal, review the documents with you and give you thoughts on those deals, do the tax based on the particular country you're looking at. So it can be really, really tailored training. And we do a lot of that work across the world, not just in the US. We do a lot in emerging markets as well. You can buy those courses directly online on our website. So you should have a link to that in the notifications of the webinar. Otherwise, go to Pivotal 180. And so with that, just quickly, I'll pass last words across back to Manish to quickly just touch on CohnReznick Capital, and then we'll take any other questions.
Well, thank you very much for your time today. If there's anything we can do to help you out with your sustainable energy finance needs, we're always happy to help out, be it consulting, M&A, capital raising, or special situations. You can go to CohnReznickCapital.com for more information. that will shift it over to any last questions.
So just open it up on the floor. Any questions? I know we've answered a lot as we went, so that pushed us a little bit over. We're very sorry about that. But feel free to post a couple of questions. We'll stick around for a few minutes and answer those. Looks like there's no additional questions. If you do have additional questions, do feel free to reach out. We thank you so much for joining us. We hope you're healthy and well, and we look forward to seeing you on any future webinars. You'll receive an email in the next couple of days just on links to the video. Thank you, and I also thank you to our friends at Cohn Reznick and Manish.
Thank you, everyone. Goodbye.